Welcome back. We are now at our final unit in the class of business, class 3, long-term insurance products. We are looking at unit 3, which is the application of structured long-term insurance portfolios. Right, who will invest in life insurance products? It will be an individual client, it will be another life insurer, it will be a pension fund, or it could be a collective investment scheme. The clients of a life insurer may be any of the following. It may be an individual client. Clients invest in life insurance in order to meet their needs, and they may have needs for life insurance, disability cover, or pure investment needs. The various products available to meet these needs we will discuss more graphically below in the next few slides. Another life insurer. One life insurer may invest in the underlying portfolios of another insurer. This gives the former insurer exposure to the growth within that organization. Pension funds utilize insurance to minimize their risk. They place large sums of money with insurers who in return then invest according to their strategy. And also collective investment schemes invest in the underlying shares of an insurer to gain exposure to the market. Right, let's have a look at the various types of life insurance, and I'll discuss this in a more graphical format just now. Term insurance, decreasing term insurance, conventional life policies, the universal life policy, which is an older type policy which you'll still find with clients, retirement annuities, investment linked products, whole life insurance, reinforced whole life insurance, pure endowment insurance, and then endowment insurance. Right, term insurance. Term insurance refers to a product with a specific term where the assurance falls away once the term expires. The time period for which the policy will pay a claim is set, and the sum assured is only paid at death. The client does not have an investment account, and these policies are issued without profits. This is a difference between the term with profits and without profits. With profits refers to a policy where the client invests a higher premium, and then part of that premium is used for investment growth. Before the amendment of Section 11W, the premiums paid by an employer or company in respect of a term policy on the life of an employer or director were deducted from the employer company's income. Section 11W of the Income Tax Act, as it reads before January 2011, provides a deduction in respect of policies where the only benefit payable under the policy is a benefit payable within a fixed period in such policy upon or because of the death or disablement of the employee or director of the whole life is insured under the policy, or the policy is a disability policy as defined in Section 1 of the Long-Term Insurance Act. Now let's look at a diagram of such a policy. You'll see that you've got a fixed term there starting at A point and ending at A point. Then you provide a level of cover. Let's say the client needs 100,000 cover. So that cover will then be available from the inception date to the end date for that specific period. Let's say that specific period that we cover here, the term is 10 years. So for a 10-year period, it will then provide 100,000 cover. But this policy is then also without any profits, which means that there will be no maturity value at the end of the product. I've used these schematic diagrams when I engage with clients because that gives them a picture of what the product looks like and how it functions, and that also helps them to remember what you've discussed with them. Right, on the next slide, we are looking at a decreasing term assurance. Now, why would you take out a decreasing term insurance? Let's say you take out a bond on a property and you pay that bond off over a 20-year term. Obviously, over the 20-year term, you will be decreasing the amount that you owe the bank as you pay down your loan. So a decreasing term assurance will help in that regard, where the sum assured or the cover amount then decreases as the policy continues. These policies are used when a loan is required or repaid over a certain period. Sum assured decreases on the loan amount as it decreases the borrowed amount is repaid by you on a loan. Now it will functions as follows. Original cover, let's say you've taken out R1 million bond on a property and you've taken it out over, say, a 20-year term, and over that period of time you pay down the bond, and the risk on that bond for the bank then decreases from the 1 million right down to when you finally pay the final amount. So a decreasing term policy would then cost you less than a policy that was remaining at 1 million over the 20-year term. Right, whole life policies. Whole life policy was largely replaced by a universal life policy, but currently the trend is back to pure whole life policies. The premium stays the same during the policy term. The annual premium in the beginning of the policy is adequate to cover the year-to-year expenses and the risk. A surplus is created which covers the higher cost. As the client gets older, the main purpose of a whole life policy is for protection. The policy will pay on the death of the life assured for the benefit of his beneficiaries, and the proceeds of the policies are then invested to provide for a family income. So this is a cheap type of product to provide a large amount of money for your client. So you'll see at the inception date, I've drawn the line there a little bit lower than the start line for the term. And the reason for that is that there's initial costs, like commissions, administrative fees, underwriting fees, and so on for starting the policy. Let's say the cover of that policy initially is R1 million. And as you age, if the premium stays level, then there's a certain amount of money that can go into an investment account portion, and over time it will then reach what they call a breakthrough point. You'll see that the end date, we've got a ruffled line there, which means that it hasn't got a specific end date. That will only be at the death of the policyholder. And at some point when there is a breakthrough point reached, then that R1 million cover might be a slight bit more than the $1 million that you initially paid for. Right, reinforced whole life policy. A reinforced whole life policy came about as a need for cheap life cover arose. This policy links a whole life policy with profits to a decreasing term assurance policy. This results in a bonus declaration being added to the basic whole life policy, and this is the same as decrease in the value of the decreasing term cover. Thus the cover remains the same until the bonuses grow to more than the original cover. Now we can explain it as follows. Initially you've got your level of cover, let's say again R1 million. Over the term, here you've got, let's say, a term of 20 years. This policy we still based on the old reversionary bonus type that has been discontinued. They brought in stable bonuses and then other types of bonuses later on. With the reversionary bonus policy, the life cover then would increase because there was a little bit of bonus also added to the policy, and at the date of payment they would add a final or an end bonus to the policy. Right, pure endowment policy pays out an amount at a certain date in future. These policies do not have life cover and will pay regardless of death. The benefits on the policy is entitled to a refund of the premiums paid plus the value of any investment growth or a fixed interest rate on the premiums paid. The life assurer makes this decision. The minimum term of these investments is 5 years, after which the client may either surrender or make a tax-free withdrawal from the policy. Again, you will see at the inception date, the initial costs causes the policy initially, when it just started off, to be in a negative because there was commissions and administrative fees and underwriting. Well, in this case, not underwriting fees because it's got no life cover. And then you've got your term. Let's say you've decided on a 10-year or 20-year term, and in which your investment account will then grow over that period, and then you'll reach your end date, let's say after 20 years, and then the investment account would have grown sufficiently to pay out what we call a maturity value or a final payout to you as the client. Then you have your endowment policy, which is a combination of life assurance that pays out at the death or at investment that provides a growth over the period. These policies are mostly with growth policies and provide clients with cover at death and an investment return. So typically on these type of policies, you could add an extra amount for death cover, for disability cover, for accident cover, and so on. The return is dependent on the bonus declared in the term of the policy. The value of the investment account will be paid to the client at maturity and has nothing to do with the value of the life cover. It's based purely on the value of the bonuses that are declared within this policy, as this is an endowment policy. Again, if I schematically got to represent it, let's say you've initially added 100,000 life cover to the policy. That's where that sum assured line is. You'll see the initial cost would then make the policy in the beginning take it into a negative value as far as the investment account. That's normally why life insurers can't provide cash values and or a loan on these type of policies, because there is no money in the policy for at least the first year or so until this policy start to earn a bit of growth on that policy. And that's why only after about 3 years they allow clients to make a loan on a policy. Now, as the investment account grows, it might outgrow the cover amount. If the cover amount, say 100,000, and it reached what they call a breakthrough point where the investment account is now at, let's say, 110, 120, 130,000, and it's moving towards the maturity date or the payout date at the end of the term of the policy, where it might pay out then, let's say, 150,000, where the life insured was covered for 100,000. So at that point of breakthrough, I mean, obviously it will pay out more than the cover amount on the policy. Right, then in the 1980s, life insurers moved away from the old conventional type of life products, and they developed what they called a universal life policy. Now, this policy has been taken out the market again since because of the cost aspect, and clients didn't always understand when you put all these various benefits and things to the policy, and they pay, let's say, 500 Rand per month, of which, let's say, 200 Rand of that 500 is used for the investment account, and the other 300 Rand is used for life cover, disability cover, trauma cover, and whatever other cover that's added to the policy. And they now go and calculate their 500 Rand per month investment, and it doesn't make sense to them why apparently the policy pays out less than they've paid in, but they forget that there was other covers also on the policy that has taken part of the premium. So the universal life policy essentially consisted of two components, namely a life cover and a disability or risk element, and then an investment element. The policyholder can, in respect of a given premium, select the amount of risk, death or disability he wants, and how much of the premium to be allocated to the savings component. And this, usually the client has forgotten that some of the premium has gone towards risk. So you had your life cover on the one hand, let's say again 100,000. You had your investment account, and then also with the life cover, you could have added things like disability or accelerated disability cover, trauma cover, accident benefit cover, and whatever else was available at the insurer. Again, you'll see the initial costs causes that there's a deficit initially in the policy. So again, a loan or cash value only starts about 2-3 years later in the investment account as it grows, and then at some stage it will reach a breakthrough point where the amount of cover would be more than what's in the investment account. Right, then you get pure risk policies. In the late 1990s, new generation pure risk policies were developed. These new generation pure risk policies offered life cover and all other risk benefits that were previously available as rider benefits. These rider benefits have become more flexible. Examples of some of these new benefits are occupational disability benefits, which are no longer connected to the life cover, and functional impairment benefits, which are offered as an alternative to the traditional occupational disability benefits. These benefits cover extensive lists of impairments, which are listed in your contract. A combination of these disability and impairment cover could have also been used. A rider is an additional to or a qualification of provisions to the policy. Now, schematically, this product would look as follows. You would have a separate life cover, which was standing on its own, a disability cover on this policy, which could be more or less than the life cover. In your conventional policies, your disability cover was never allowed to be more than the life cover, always less or equal. In this product, you can then add more disability than life. So if the client's need is greater for disability than for life cover, this product then enabled you to vary the amounts according to the need. Then you could have added separate dread disease cover, and you could have added another amount of accidental death cover separately to this policy. So this policy didn't have a fixed term. It was similar to a life type of product with all these various life covers, standing independently and the one not affecting the other. Right, retirement annuity products. A retirement annuity is nothing more than a one-person pension plan. You apply to become a member of a retirement annuity fund, which is approved as such by the Registrar of Pension Funds and the tax authorities. No employer-employee relationship is required to qualify for memberships. RAs, or retirement annuities, are the main savings vehicle for self-employed persons to accumulate funds for retirement in a tax-efficient way. They are also popular as a top-up plan for salaried employees who belongs to a pension fund and wants to increase the gap between their pension and what they need for retirement. Now, we can represent this as follows on a schematic diagram, where you've got a lump sum. Let's say you invest a lump sum of 200,000 and you invest that over a term of 10 years. Then the retirement annuity structure would then eventually pay you out, let's say, 2,000 Rand per month. A term certain, that's the top one that I've given you there, which is the term is then certain for a 10-year period. If we look at a life annuity with no specific end date, and you've invested a lump sum, and let's say the monthly amount is also 2,000 in this, then this one will continue for as long as you're alive or until you then pass this on. So these are typical examples of retirement annuity products where the 2/3 part then can be used in the format of a lump sum that you apply and create a monthly income from that for yourself. Right, what is the tax savings on an annuity product? Contributions are tax deductible up to a certain maximum. Currently, it's capped at 27.5% of the greater of remuneration and taxable income within a maximum of 350,000 per annum. Disallowed contributions can be carried over to the next year of assessment. Inside build-up of the fund is currently taxed at 9%. Your lump sum on death or retirement is tax-free up to 500,000 currently. The balance of the tax-free lump sum is taxed at a very favorable rate. On death, any benefits paid out by way of an annuity are free of estate duty, which means a retirement annuity is the same as a pension fund, so it does not go through the estate. If you leave your employer and receive a withdrawal benefit from your pension or provident fund, you can preserve this as a retirement benefit by transferring it into a retirement annuity fund, tax-free. At retirement, you have a choice between a conventional annuity or an equity-linked living annuity. You can also transfer the funds in a retirement annuity product to any provider that can provide you with a annuity income. An RA can be used to build up a fund for post-retirement medical expenses in a very tax-efficient way. Right. What is investment-linked insurance plans? Investment-linked plan is a life insurance plan which combines investments and protection. The premiums of that you pay provide you not only with life insurance cover, but part of the premiums will also be invested in specific investment funds of your choice. As a policyholder, you can choose how to allocate your insurance premiums towards protection and investment. How does this work? A portion of your premium payment is used to purchase units in the investment-linked funds managed by the insurance company. The protective coverage is provided by paying the risk charges via deductions of units from the investment funds. What are the main features? It's low premiums. You buy investment units in the fund of your choice. You have a choice of funds to invest in. You enjoy benefits of life insurance protection. You can withdraw cash as and when necessary. You can also switch from one fund to another. Options to top up the investment at any time, and insurance charges are deducted monthly from the units you hold. How do I track the performance of my investment? Your investment updates can be tracked in daily newspapers, for examples in the Beeld, the Star, and so on. Look in the business section, you will see the investment-linked product column. Why should I buy this product? The product gives you the opportunity to participate in an investment scheme which only requires a small investment, so you can have the access to professional investment experts in the insurance company. You benefit from diversification through the spread of investments which reduce the investor risk exposure in case of there is a drop in the value of some of its investments. You enjoy benefits of insurance protection, and you have flexibility in your investment through top-up and switching. Benefits of investing in linked insurance products. There's a wide spectrum of investment choices. You've got flexible premiums, variable sum assureds, variable death benefits, partial surrender, withdrawals are allowed, and capture the benefit of investing in investment funds. There are various supplementary benefits, which includes a waiver of premium benefit, capital disability, critical illness cover, disease benefits, accident benefits, guaranteed assurability, funeral benefits, permanent health insurance, hospital cash plans, and major medical cover. Disability also includes monthly income protection policies, lump sum capital disability policies. Disability definition and types of cover include occupational disability, functional disability, and physical disability. Let's have a look at critical illness cover, also known as dread disease cover or trauma cover, living benefits or survival benefits. A critical illness cover compensates an insured suffering from a major setback in health through serious illness or trauma which is or has significant impact on his quality of life and possible life expectancy, and often results in financial difficulties. The cover is for a limited number of health events which are clearly defined in the policy. When first introduced in South Africa in the 1980s, the cover was only for heart attack, stroke and cancer, but subsequently the range of conditions covered by these products in the marketplace have considerably extended to conditions such as renal failure, motor neuron disease, blindness, total deafness, multiple sclerosis, Parkinson's disease, Alzheimer's disease, and others, and also to the undergoing of certain surgical procedures and as coronary bypass surgery, heart valve replacement, organ transplant, angioplastic, and so on. Right, accident benefits. Accident benefit pay out in the event of accidental injury, for example, a motor vehicle accident. The benefit may be as much as the sum assured or part thereof. Sometimes this benefit also covers serious injury, such as the loss of a leg due to an accident, the loss of a hand or a body part. Guaranteed insurability benefits. This benefit entitles the insured to buy additional life cover, not exceeding the existing life cover, without proof of medical health. However, should the life insured have AIDS, for example, the life office will cancel any future policy. Right, funeral benefits. There are legal limits on the amounts of cover for children. We've seen this previously in some of our sessions we presented. Children under the age of 6 is a maximum of 20,000. Children between the ages of 6 and 14, a maximum of 50,000. And for anyone older than 14, insurers apply for their own cover limits. This benefit is paid out as soon as the life assured dies. The cover may be used for benefits of the insured or of his immediate family. Permanent health insurance. Permanent health insurance benefits are paid to the life assured in the event of serious illness preventing him from working. The life assured receives a monthly payment that is restricted by amount of his salary. Limitations are placed on the amount of these benefits by a CISA in order to minimize abuse. Hospital cash plans. Each life company has its own products with its own different set of rules, but the basis of a hospital cash plan is to provide the insured with a daily amount while he is in hospital. Most plans include hospitalization of the dependents. These plans do, however, have a number of exclusions that must be noted, namely pre-existing conditions for the first 2 years, AIDS and other sexually transmitted diseases, maternity confinement, cosmetic surgery, hospitalization due to the abuse of alcohol and drugs, attempted suicide or inflicted injury. Due to the high cost of medical care and medical aid contributions, the assured may take out additional insurance to cover this shortfall. This benefit is not linked to the life cover and is seen as a separate benefit. Payments of benefits cannot be linked to the actual cost of the medical treatment, as the cost is the responsibility of medical aid. So take note that the hospital cash plans and major medical benefit plans are separate to a medical aid fund, which covers other costs. Also see the demarcation regulations regarding gap cover. Right, and then we're going to conclude with the reinsurance market just briefly. Participation in this market, conducting reinsurance business, governance and capital adequacy and reporting, treatment of reinsurance for solvency assessment and direct insurers, create a level playing field, adjust measures to use to assess risks. There's reinsurance contracts that's in place, and transparency and accessibility of information, and also your IFRS and tax. Right, here's just a graphical representation of the number of insurance conducted or conducting reinsurance business. You can see there the green area, the long-term insurers, 41%. Professional reinsurers in the long-term industry that we've broken down for you because it's a very, very small percentage. 2% and 2% of that block of 14%. Your professional reinsurers, which is 4% of that block. And then your short-term insurers, including Lloyd's, which makes out the bulk here, which is 51%, and then your professional reinsurers in short term, which makes out about 2% on that small little graph that we showed you there. Thank you very much for attending our session for Class 3 long-term insurance products. This ends our session. Best of luck with your exam. At Integrity Academy, we afford you 2 opportunities to write the exam. The exam consists of multiple choice questions. There's 40 questions in the exam paper. We give you 2 minutes per question, which then will give you 80 minutes to conclude the exam. Please read the multiple choice questions carefully. Make sure that you understand what is asked in the multiple choice question before you answer. You can also skip questions as you move along and then come back to questions. If you fail your first attempt, you can then make use of your second attempt to try and pass the exam. Please don't rewrite the exam attempt, the second attempt immediately. Please go through your material once more before you retry the next attempt, because you're going to make the same mistakes you made in the first one, and then come back to the second attempt. If you are so unfortunate to have failed your second attempt, you can then purchase a third and fourth and fifth attempt from us. I trust that this will not be necessary. We wish you best of luck with the exam and your preparation. Thank you for attending our session, and thank you for making use of Integrity Academy. I am Johan Klute, the Managing Director of Integrity Academy. I thank you for your time.